What's up, guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers, so please be careful. Don't get yourself scammed. Guys, get down in that description box, click on that Instagram link. Give your boy a follow on Instagram. And then send me a DM. Let me know that you're rocking with me. I really would appreciate that. Again, Instagram link down in the description box. Richard Fain, Millionaire Mentor. Get down there to that description box, click on that Instagram link. Give me a follow if you don't mind. If you're an Instagrammer and you do the Instagram thing, give me a follow. I really would appreciate it. Trying to get this Instagram page up and popping again since they closed down my last one. So do me a square, do me a favor, give me a follow on Instagram. I would appreciate that. Like I said, that Instagram link is down in the description box. Richard Fain, Millionaire Mentor. Also, guys, do me a huge favor. Go check out my new website. That link is down in the description box. Richard Fain, Millionaire Mentor website. It's been up for about 2 weeks today. And I must say, man, you guys have really been awesome. Thank you. I appreciate you guys seeing the value in the website and the digital products that I've picked out personally. I picked out these digital products personally, and I appreciate you guys really supporting that. And again, it's really an investment in yourself. A lot of good digital products to help you get to your pot of gold at the end of the rainbow. So thank you very much for everybody that's went to the website. And for those of you who have not been to the website, I would ask you to give it a shot. Give it a try. That link is down in the description box. It's the second link in the description box. www.richardfain.net is the website address. Go check it out. Let me know what you think. Send me an email and let me know what you think about the digital products. Hopefully you'll see value in the digital products, make an investment in yourself, and use that information to execute and get to your pot of gold at the end of the rainbow. And then also, in the website, through the website, you can also sign up for the membership club. That's a paid membership club that I'm going to be driving, and I got a lot of passengers. I got a lot of passengers already. A lot of you guys have already signed up for the paid membership club, and I appreciate you rocking with me. For those of you that have not, consider it. It's gonna be a different mix than we do on the YouTube channel, right? This is going to be more mentoring than what I do on the YouTube channel. The YouTube channel is just information. You know, I give you guys my 25 years worth of information, whether it be in banking information, real estate, stock market, side hustles, businesses. I give you that information the way I want to give it to you on the YouTube channel. In the membership club, it's going to be different because the members are going to direct how the conversation goes in the live streams. They're gonna send me topics, things that they want me to discuss, and then that's what we'll discuss on a weekly basis for 90 minutes. So excited about that. Our first live stream in the membership club will be the week of May 6th. So less than a week. Next week, this time, we'll be getting ready to go into the live streams for the membership club. So if you want to be a part of that and all the other stuff that I send on a daily to the membership club, get over to the website, sign up, grab you some products, get yourself to your pot of gold at the end of the rainbow. All right, last thing, guys, is Moomoo. Of course, Moomoo is offering you 10 free fractional shares of the Magnificent 7 stocks. They're going to give you 10 free fractional shares of the Magnificent 7 stocks, right? All you got to do is go down to the description box, click on the first link, which is the Moomoo link, sign up, put your $100 in your new brokerage account, and then you're going to get 10 free fractional shares of the Magnificent 7. The 7 top valued companies in the United States are in that free offer. you're going to get fractional shares of it. So if you want that, certainly get yourself down to the description box, click on that Moo link, go get that free stock, go get that free money. Well, guys, let's dive on into today's topic. Well, we got a lot of topics we're going to cover, but let's start with the headline topic, which is another major bank fails, collapsed. First failure of 2024. Yep. And experts are saying many more to come. Many more to come. That's pretty, listen, that's something that you got to perk up and pay attention to, guys. You got these banks that are going to be failing. And this one right here that I'm getting ready to walk you through is just the first one, right? It's just the first one. Here's the headline. U.S. regulators seize troubled lender Republic First. Stepped in, closed them down. Let's figure out why they closed them down. I mean, I got an idea why they closed them down, but because I've been telling you guys this for months. I've been telling you these regional banks, these smaller banks are going to be in trouble. A lot of them are going to be in trouble because of the loans that they have on their balance sheet and the investments that they've made with your deposits. Now, some of those they've taken some of those deposits and made loans, but they've also taken some of those deposits and did other creative things with to try to make money, and it's coming back to bite them in the rear end. So let's read on and figure out what happened to this Republic First. So U.S. regulators have seized Republic First Bank Corp and agreed to sell it to Fulton Bank, underscoring the challenges facing regional banks a year after the collapse of 3 other regional banks. So you remember what happened in 23, where you had the run of these banks, these regional banks, small banks collapse, right? This is the first one of 24. So we're basically in the month of April, and boom, we got our first failure. But like I said, many more to come. At least that's what experts are saying. Philadelphia-based Republic First, which had abandoned funding talks with a group of investors, was seized by the Pennsylvania Department of Banking and Securities. The Federal Deposit Insurance Corp, FDIC, appointed as a receiver. Basically what that means, guys, is a receiver basically steps in, takes over the operations of the bank, a company. They step in and they make sure that everything is running properly and everything gets taken care of until they can dismantle the bank or dismantle the company, and they make sure all the assets are accounted for, all the liabilities are accounted for. That's what the receiver does. Typically court appointed or appointed by FDIC. The Federal Deposit Insurance Corporation appointed as a receiver, that's what they've been appointed, right? As the receiver for this failed bank, said on Friday, Fulton Bank, a unit of Fulton Financial Corp, will assume substantially all deposits and purchase all the assets of Republic Bank, which is operating name for Republic First to protect depositors. That's important, guys. So this Fulton Bank has stepped in and they're going to purchase, right? They're going to assume all the deposits and purchase all of the assets of Republic Bank, which is the operating name for Republic First. So there we go. Fulton Bank is going to step in and say, well, okay, we'll take the deposits. That way, none of the depositors have to worry about losing their money. And then also, we're going to take all the assets. But here's the thing you got to understand. They've agreed to do that because the federal, FDIC has already have a sweetheart deal with them and saying, hey, if something goes wrong, toxic with these assets, these loans, we'll backstop you. We'll make you whole. So I guarantee you the FDIC has cut a deal with them in order for them to step up and take on the liability that they're going to take on in order to, absorb this Republic First Bank, right? Republic Bank had about $6 billion in total assets. So not an incredibly large bank, but still $6 billion in total assets and $4 billion in total deposits. That's still a decent sized little small bank, right? As of January 31, 2024, the FDIC estimated the cost of the failure to its fund will be about $667 million. So the FDIC fund is going to have to pony up about $667 million to make this right, to make this the Fulton Bank absorb this failed bank, right? Now, don't get me wrong. Banks, they do contribute to this FDIC fund. Banks do, right? In order to be a member of the FDIC where your depositor is protected, you have to pony up some money. And I believe the bigger the bank is, the more they pony up, right? But I still look at it this way. At the end of the day, there's still some taxpayer money wrapped up in there somewhere. So you and I still are on the hook somewhere in this whole equation, right? That's my opinion. I'm no expert here. I could be wrong, but I've seen this before. Somewhere along the way, you and I as taxpayers, we're on the hook for this too, right? Even though I know the FDIC collects money from other banks for the FDIC fund, I still say you and I as taxpayers, we're on the hook in here somewhere. So Republic Bank had about $6 billion in total assets, $4 billion in total deposits. FDIC estimated the cost of the failure to the fund. When they say to the fund, they're talking about to the FDIC fund, is going to be $667 million, right? Almost $750 million. That's a lot, guys. Apart from deposits, Republic also had borrowings and other liabilities of approximately $1.3 billion, Fulton said in a statement. Fulton said the deal almost doubles its presence in Philadelphia market with combined company deposits of approximately $8.6 billion. So like I said, not a huge, even when they roll them into Fulton Bank, it's still not a huge bank, not compared to these big boy banks, right? These big boy banks have $1 to almost $2 trillion worth of total value, right? Way, way bigger than these little ones. But these little ones are, when you multiply them across the country, that's these little ones are the ones that make up the majority of the banks when you look at it across the country, right? With this transaction, we are excited to double our presence across the region. And this is coming from their chairman and CEO. Republic Bank's 32 branches in New Jersey. So if you guys live in New Jersey and Pennsylvania and New York, hopefully this will be a smooth transition for you if you were a customer of this Republic First Bank. Branches of Fulton Bank on Saturday and Monday during business hours they'll reopen. The decision marks the latest U.S. regional bank failure following the unexpected collapse of three lenders, Silicon Valley, Signature, and then First Republic. So this is the fourth one, right? Republic Bank had struck a deal with an investor group that included veteran businessman, whatever his name, George Norcross, a high-profile attorney, Philip Norcross, late last year, but the effort was terminated in February. After that deal collapsed, the FDIC resumed efforts to seize and sell the bank, according to Wall Street Journal, which has reported the news. First Republic cut jobs and exited its mortgage origination business in early 23 as it reeled under pressure from higher costs and the inability to improve profitability. The bank's stock price has tumbled from just over $2 at the start of the year to about 1 cent on Friday, leaving it with a market capitalization below $2 million. So it goes from $2 a share down to a penny with about a $2 million cap, which is not good. Its shares were delisted from the NASDAQ in August and now trade over the counter. Wow. That's bad, man. That's bad. So there's your first regional bank of 2024 kaput. And like I said, the likelihood of there being more is a good likelihood, right? Because what these people suffered from in this bank is trying to make money in this environment, right? You got loan rates through the roof, right? So most people can't borrow money from you no more because loan rates are too high. The loans that you do got on the books, most of them were probably commercial loans, commercial real estate loans. And those commercial real estate loans or other commercial loans, they started going bad because of what? Small businesses are not doing as well. Small businesses were the bulk of their customers, right? Like that Philadelphia, that Pennsylvania area, that New York area, that New Jersey area, small businesses in those 3 tri-states, that was the bulk of their customers. The problem was when you're in an economy like we're in, where you either feast or famine. Feast up here, if you're the 1%ers, you're in a feast economy. Down here as 99%ers, including small business owners, you're in a famine economy, right? You can't borrow money. You don't have access to borrow money because the rates are too high. You don't have a war chest because we already know 75% of small businesses are undercapitalized. So that means they don't have any cash reserves. They basically operate on whatever revenue they bring in. They don't have any cash reserves. That's 75% of businesses in the United States, small businesses. And then we already know 95% of the businesses in the United States are small businesses. So when you get these regional banks, guess who their customers are? Their customers predominantly are people like you and I and small business customers. So if we don't have access to borrow money cheaply to be able to make things work, right? We get laid off from a job, or if I'm a small business owner and I can't hire people, I can't expand my business, I can't generate more revenue, and I got a loan with you and that loan's coming due, and it's gonna, my rate is 4%, but it's gonna jump up to 7.5% at renewal, you just can't pull it off. So what a lot of these small regional banks do, they take your deposits in order to generate money. This is the only way they really make money. They take your deposits and then they go out and lend those deposits to people, to businesses, to real estate investors, to regular people like you and I. They lend that money out and expect an interest. They expect a return. The problem is with the economy the way it is, and 99% of us down here in this famine economy, in this cesspool economy that former President Trump calls it, most of us are struggling to take care of our basics. So if I'm down here in this economy that I'm struggling to take care of my basics, your loan ain't at the top of the priority list. Your loan payment don't come before me feeding my family. Your loan payment don't come before me providing shelter for my family. Your loan payment don't come before me trying to put gasoline in my car so I can get to work. Your loan payment comes last. So that's what goes to happening with these little small banks that are, the only way they make money is through lending money. When times are good now and people are paying them, they make money. When people are hurting and have to prioritize where their money goes, and the loan payment is the last thing they're prioritizing, that's when they get hurt. That's when they get hurt. So their loan portfolio starts going bad. People stop paying them. They start to get in defaults. First it's 30 days late, then it's 60 days late, then it's 90 days late. They're not collecting any interest, but yet and still they got all this overhead. They got these, like they said, they had these, you know, they're in 3 states. So they got these brick and mortar buildings. They got these employees. They got benefits, right? They got other operating costs associated with being a bank. They got to pay the FDIC. They got to pay this. They got to do that. They got all this outlay, but they have no money coming in because the loan portfolio has stopped performing. Then they've taken your money and put it in other instruments that they felt like they could get a return on. Maybe they did that 3 years ago. But here's the problem, and here's a good example. You know, a bank like this with $4 billion in deposits, maybe they take $500 million, maybe they take 500 million and put it in something like a 5-year treasury bond. Maybe they did that 2-3 years ago when that note was, your 5-year treasury bond was 2%. Let's say today a 5-year treasury bond is 4%. The problem is they can't really sell that treasury bond on the secondary market because no one's going to give them their 500 million back when I can take my 500 million and go get me a 4% brand new treasury bond. Why would I give you 500 million for a 2% treasury bond? The only way you sell that treasury bond is you got to discount it. You got to discount it. No, you don't have to give me face value of the 500. Give me 300. Give you a $200 million discount. The problem is that $200 million are deposits that belong to your customers. Where do you get that money from? So bad investments, bad loans lead to this right here. Mismanagement of the bank, bad loans, bad investments bring you to this point where you have to close your doors and the FDIC have to come get you. That's what happens. There are many more out there just like this, guys. My only recommendation to you is figure out who you're banking with, where you got your money. You better figure out if it's one of these regional banks, one of these small community banks, you better make sure they are on sound footing. Now, good news is you got FDIC, but that's only for people who have $250,000 or less. That's what FDIC covers, up to $250,000. You got $1 million in some little small bank, you better rethink it. Because if that little small bank collapses, FDIC is only going to give you up to $250,000. That's all they protect you up to, guys. So anybody that got more than that $250,000 in there, you may want to rethink that. You may want to rethink it. You may want to spread that money out a little bit so that you're not in jeopardy if one of these little small banks go out of business. That goes for credit unions too. I know somebody just popped in the chat, credit unions. Listen, man, I love credit unions. But again, guys, I look at a credit union as a small bank, a small community bank. Even though it's a credit union, it's still a small community bank compared to the big boys, right? So, you know, just be careful. All I'm telling you is I'm giving you information so that you can protect yourself. I'm not telling you to move your money nowhere. I'm just telling you, you know what's happening. You see it right here. Here's the first one of 2024. They expect many more to come. All I'm telling you is make sure wherever you got your money, you know what this bank is doing. You know how they make money. I'm telling you what these banks do to make money. I was in banking for 25 years. And part of that time, I worked for community banks. I'm just saying. So I know how they make their money. These community banks, these small regional banks, they make their money off loans. It's called net interest income. It's coming from loan interest. People pay them for loans. That's how they make a good part of their money. And they take your deposits and they invest them in things like U.S. Treasury bonds or other type of instruments. The problem is when those two things go bad, that's the only way they make money. See, they ain't got no Forex desk. They don't have no international banking desk. They don't have no derivatives desk. They don't have all these other lines of business like Wells Fargo and Bank of America and all these guys. They got 8,500 lines of business where they make money. These little banks don't have that. The only way they make money is with loans and little investments that they make. And most of those loans are going to be in real estate. Just telling you. Protect yourself. Be careful. Be careful. All I'm saying is just be careful. I'm not saying panic. I'm not saying take all your money out of your little small bank you got it with. I'm not saying that. I'm just telling you, know what's happening in the banking world, who's in jeopardy, and you know who in jeopardy. That's small regional banks, and small community banks, which I include credit unions in that. Those are the banks that are in trouble, not your big boy, too big to fail. We're going to talk about them because they're losing some money too. But the regional banks, because of what's happening in the commercial real estate market, are susceptible to failing because a lot of their balance sheet is full of real estate investment loans. And I guarantee if you look at the balance sheet of these folks right here, they got some loans on there. And probably a portion of them are commercial real estate loans. It'd be interesting to see what part of the loan portfolio is going bad. Is it consumer loans? Is it real estate loans, like commercial real estate loans? Is it the mortgage portfolio? It'd be interesting to know which ones. I didn't go that in depth to it. I'm sure it's out there. I just didn't go look for it. Be interesting to know when you look at the balance sheet, what's bad, who's not paying. Is it consumers? Is it real estate investors, right? Is it businesses, true business loans? Who's not paying? They didn't get into that in this particular piece, but be careful, be careful. Let's talk a little bit about these big boy banks because they got themselves in some trouble too. I tell you, this whole banking thing is going crazy, right? Going crazy. So here we go. Here's the headline. JP Morgan Chase and Bank of America suffer $4.5 billion. Let me just run that by you again. $4.5 billion in losses as uncoverable debt soars. So if big boy banks, I'm talking about big boy too big to fail, set to lose $4.5 billion, what do you think gonna happen to these little small banks? You got big boys losing $4.5 billion. What do you think gonna happen to these little bitty banks? These little regional banks, these little community. That's what I keep telling you guys, know who you're banking with. That's all I'm saying. The two largest banks in the US are declaring a loss on $4.5 billion in debts that consumers are unable to pay. So who around here, what is this guy talking about? He's always talking about gloom and doom. I mean, this is not happening. That's not true. We're in a great economy. Well, why in the world would two of your largest banks in the United States being set to lose $4.5 billion because consumers stop paying them if we're in this such great economy? I don't know. Y'all tell me. Does that make sense? Does that make sense? We're in this wonderful economy, but you got $4.5 billion getting ready to be written off by your two largest banks in the country because people stop paying them. Help me out here. Help me out. Somebody help me out. Figure out how in the world could we be in this wonderful economy when you get this right here from two of your largest banks in the country? I don't know. Coupled with, you got your regional banks failing. Guys, we gotta pay attention and know what's happening. That's all I'm saying. We gotta pay attention and know what's happening in our economy. If we're gonna be good investors and we're gonna know how to make moves and build wealth, we gotta know what's happening around us. See, you can't sit inside your house and not know anything about the financial world and expect to build wealth. You gotta know something so that you know how to move. You know what positions to take. You know what stocks to buy, what ETFs to buy. So here we go. JP Morgan Chase says its net charge-offs, which are debts that the bank does not expect to receive, hit $2 billion in the first quarter of this year. These guys done lost $2 billion because people won't pay them. That's the first quarter. What do you think gonna happen the rest of the year as the Fed keep these interest rates higher for longer? Right? What do you think is gonna happen for the rest of the year as the Fed keeps interest rates higher for longer? Remember, tomorrow and Wednesday of this week, the Fed will be meeting. Keep that in mind, guys. Guys, as you get in the chat, hit that thumbs up button for me. I really would appreciate it. Hit the thumbs up as you come in here or however you see in the video. Do me a big favor. If you appreciate the information that I'm sharing with you so that you will be a better investor, please hit the thumbs up for me. I really would appreciate that. First quarter, $2 billion. Okay, let's keep moving. That's nearly twice the amount of unrecoverable debt compared to the same quarter last year. So in 2023 first quarter, they lost $1 billion in the first quarter. 2024 first quarter, $2 billion. So it's double in 1 year. That doesn't seem like things are getting better. Somebody help me out here. If I go from 1 trillion a year ago, I'm sorry, 1 billion a year ago, right? It's 1 billion, right? Make sure I get my numbers right. Yeah. If I go from 1 billion a year ago up to 2 billion the following year, that doesn't seem like things are getting better. That seems like things are getting worse. Just saying, just so that we're on the same page. Meanwhile, Bank of America reported 1.5 billion in net charge-offs, a surge from 807 million a year ago. B of A almost doubled too. They went from 807 million to 1.5 billion, almost double. B of A says those losses stem mainly from credit card debt that will likely never be paid. See? I don't know if y'all remember a couple days ago, I was reading something to you guys where somebody was saying, oh, the credit card debt, it's blown out of proportion. I was reading this article with some expert. Oh, it's blown out of proportion. It's not that bad when you add in inflation and all this other crap. It's not that bad. Okay, tell Bank of America that. The bulk of that 1.5 bill, they say it's going to be credit card debt where people just won't pay them. So what economy are we in? Somebody help me out here. Which economy are we in? Are we in a glorious, glory days, money flowing like champagne out of a champagne glass? Or are we down here in a situation where people are struggling? Somebody help me out. I don't know. How do you protect yourself from that? You got to build wealth. You got to turn to assets. You got to turn your money away from buying things that make other people wealthy and turn your money towards assets. That's how you buck all this. See, this is how you miss all this. Miss all this by having assets, right? So Bank of America is seeing cracks in the finances of borrowers with below prime credit scores, whose household spending is affected by higher interest rates and inflation. Guys, listen, man, I'm no expert here, but you guys got to understand I've been doing this for 30 years. I'm not an expert, but I've been doing it for 30 years. I've seen this. As the Fed keep these rates higher for longer, it gets worse. Doesn't get better. Because see, America, we need to borrow money to make it. Problem is, we borrow too much money, and then when times turn on us, we can't pay. That's our problem. Our problem is we borrow too much. But we've been trained that way. We've been trained to do that. We've been programmed to do that. We have, from birth. We've been trained and programmed to borrow as much as you can borrow. And if you can't pay us back, okay, we'll forgive you in 2 or 3 years. We'll ruin your credit for 2 or 3 years, and then we'll let you back in the game. Do it all over again because our economy depends on that. So Bank of America, they're not mad. They already knew this was going to happen, so they put aside money for these losses. They put aside money. These big boy banks, they put aside money because they know people gonna not pay them when times get rough. They already know that. So they put aside money for this. So it ain't like it's gonna affect Bank of America's stock price. It's not gonna affect JP Morgan's stock price. Why? Because they already knew this was gonna happen. They've told their investors it was gonna happen. And they said, okay, investors, we know there's gonna be a segment of our population that ain't gonna pay us because they can't. Do I buy food or do I buy a Bank of America credit card bill? Or do I buy food for my family? Right. So they already knew that. So they tell their investors, listen, guys, we already know people are not going to pay us. And this is the percentage of people we believe won't pay us. But here's what we're going to do. Since we're so profitable, we're going to take some of these profits and we're going to put them to the side. They call those loan loss reserves. We're going to take some of our profits and we're going to put them to the side in anticipation of these people not paying us. See, as long as the bank tells the market that, and the market knows that they're taking profits and putting it aside, so when people don't pay them, it's not a big deal, their stock price doesn't suffer. When their stock price suffers is when they don't tell the market people ain't gonna pay them, and they haven't put money aside for loan loss reserves. That's when their stock price gets hammered. Right now, you ain't gonna see nothing happen to Bank of America's stock price or JP Morgan, because they already got billions of dollars set aside for these people who don't pay them. Because they understand that's the cycle in our economy. They understand that's part of our financial system. Part of our financial system is this: make these people borrow as much as they can and spend as much as they can to make us rich. When the economy turns on them, we will let them get out of loans and not pay us a certain percentage. We already got rich. We'll let them do that. And guess what? We'll ding their credit for a few years and then we'll let them back in so they can do it all over again. Because if you don't learn anything, you'll repeat you'll repeat this. And they know it. But they know they're going to get these losses. They plan for this. They know a certain percentage of us ain't going to pay them. They already know this, guys. So it's no surprise to them. Bank of America is seeing cracks in the finances of borrowers with below prime credit. So below prime credit is somebody that has a credit score in the low 600s or worse, right? That's below prime. Prime credit is people with credit scores of like 720 or higher. Anybody less than that starts to fall into that what they call subprime or below prime. Guess what? When you're in subprime or below prime, you get a higher interest rate. Why? Because you're a higher risk to not pay them back. That's why they keep credit scores, guys. That's the only reason credit scores exist, so that they know exactly which one of y'all ain't who have the likelihood to never pay them. It's the way it is. They know exactly who may not pay them. That's why they keep credit scores, so that they know that, right? Bank of America is seeing cracks in the finances of borrowers with below prime credit scores whose household spending is affected by higher interest rates and inflation. See that I've been telling you all this for months. The Fed know what they're doing. See, the Fed know what they're doing. They know how to stop y'all from spending. They keep them interest rates up. They jack them interest rates up. Them 22% to 25% on them credit card balances, at some point it catch up to you. It will catch up to you at some point. And the Fed knows that. So they're saying to themselves, okay, we got this red hot labor market. Okay, we got this red hot economy. Okay, we got something for you. We're going to keep these rates higher for longer. So when they meet tomorrow and they meet on Wednesday, the Fed chair going to come out and say, listen, guys, we're not reducing interest rates. We're going to leave them where they are, and we're going to leave them there until we're satisfied that y'all have stopped spending and running up inflation. The problem is the American people ain't got it yet. We keep spending. We keep on spending. That's why inflation won't come down. We just keep spending. Guess what's going to happen? Them rates going to stay up there for higher, for longer. And at some point, something's going to break. Something's going to break. We're going to break as consumers, or something else in our financial system is going to break. And when it does, that's when they're going to reduce rates. But they're not going to reduce them until something breaks, right? They're not going to reduce them until something breaks. While lenders earn money from interest payments, they seek to avoid situations in which customers fall so far behind on loans that they have to write them off. Net charge-offs are also on the rise at Citigroup and Wells Fargo, as a recent poll from the Federal Reserve finds most banks are now tightening lending standards for most types of loans. See, that's why you can't go in there no more and get some signature loan. Oh, I got 720 credit score. Give me a $15,000 shake your hand loan and no collateral. They ain't doing that no more. They ain't doing it no more. You can barely go in there and get a loan for a house. So you know they ain't finna give you no unsecured loan. That's done. That's done. The only way you get a loan like that, guys, you gotta have money with that bank. You gotta have investments with that bank. You gotta have a really super duper good relationship with that bank. They're just not gonna let people walk in there and be like, oh, I don't bank with you, but I got a 720 credit score. Give me $50,000. Well, what are you gonna do with it, Richard? I don't know. I'm just gonna, I'll find something to do with it. No, Richard, we can't do that. See you later. That's what they're gonna tell me, right? They're not doing it. Why? Because they know people are in trouble and they know the level of defaults and people not paying them is starting to increase. So what are banks doing now? They're starting to tighten down the hatches. They're saying to their lenders, listen here, guys, I don't care if they got a 720 credit score. I want their debt to income ratio to be 25%, 30%. That's it. If they're higher than 30%, decline them. That's what they're gonna do. That's that they have to, because if they don't, if they get too greedy, it'll come back to bite them, because they know people are hurting right now. If people wasn't hurting, they wouldn't have $4.5 billion in charge-offs, right? So net charge-offs are also on the rise at Citibank and Wells, as a recent poll from the Federal Reserve finds most banks are now tightening lending standards for most types of loans. Banks reported tighter standards and weaker demand for home equity lines of credit. Moreover, for credit card, auto, and other consumer loans, standards reportedly tightened and demand weakened on balances. So as they started tightening the lending guidelines, making it harder for you to get a loan from them, making you jump through more hoops to get that loan, a lot of us gave up and said, that's okay, I don't even want no loan. Not if I gotta pay 8%. No, I don't want that loan if I gotta pay 9.5%. No, I don't want that HELOC if I gotta pay prime plus 3, prime plus 4. I don't want that HELOC. So guess what happens? They don't make as much net interest income because they're not making as many loans, but they're not making as many loans because they know a lot more people are going to default on those loans. And it just comes back to bite them, right? Just comes back to bite them. But see, JP Morgan Chase, Wells Fargo, Bank of America, Citibank, they can do that because they have other ways of making money outside of loans. They're huge banks. These are all $1 trillion plus banks. They got like I said, Wells Fargo got about 85 ways to make money, 85 lines of business. So JP, Citigroup, and Bank of America got that too. The problem is your little small regional banks and these community banks, they got 2 lines of business. Making loans and collecting interest off of those loans, and then doing what? Taking your deposits and putting them in other shady stuff, right? To make more money. Because see, the way they look at it is these deposits are just sitting here. We have a right to take them and invest them in something else. So that's what they do. Problem is when times are good, they can get away with that. But when times turn ugly like they are right now, they can't get away with it. So they start folding. Plus, they ain't got the highest level of management, to be honest with you. A lot of these people who run these regional banks, run these small community banks, they ain't Jamie Dimon. They ain't that skilled. I'm just gonna be honest with you. I done worked in these banks before, man. They ain't that skilled. So then all they are a couple of investments away from disaster. And that's what you're starting to see happen with Republic First. Just a couple of things away from disaster. Couple of bad investments, couple of loan defaults, So if you know the big boys are 4.5 billion in the first quarter, imagine what these little guys are doing, the losses that they're having. I'm just saying, just think about it. Despite the losses, both JP Morgan Chase and Bank of America said their balance sheets are sound. I tried to tell you, because they got more than, they don't just make loans to consumers and businesses. They do all kind of stuff, guys. These guys do all kind of stuff to make money, right? The general bank is just one of their money makers, but they got other lines of business, big businesses. So keep that in mind. Why in the, here it is. JP Morgan Chase earned $49.6 billion in profit last year. JP Morgan made almost 50 billion, guys, in profit. I'm talking about profit, not top line revenue, but profit. So they can take a piece of that profit and they can put it on over there in loan loss reserves to cover any losses, and they're still profitable. 50 billion, guys, went to the bottom line. Bank of America had about 25 billion. JP twice as much as Bank of America. JP 50 bill, Bank of America 25 bill. See, that's how they can absorb all of this. They take a part of that 25, 50 bill and they set it to the side and say, we know some of these people ain't gonna pay us. So we got money set aside. So when they don't pay us, we'll dip over there, take some of those profits, pay it, get our balance sheet right. We keep moving. But guess what we're gonna do? We ain't gonna lend them no more money. Let's let this thing wiggle itself out before we lend them any more money. So tighten up those guidelines. We don't want nobody under a 720 credit score doing this or doing that. If we gotta give them a loan, car loan, 14, 15, 18% if they're subprime. If they're prime, 7.5%, 8.5%. So if we're going to lend money, we're going to price it for the risk. That's basically what they're doing, guys. They price it based on the risk. When they jack them rates too high, they know most of y'all ain't going to be able to qualify. You're not going to be able to pay for it. So they weed you out. They just keep increasing the interest rate to weed you out. Oh, your credit score ain't high enough. Oh, you got a 30-day late over here on this credit card bill. Oh, no, can't mess with you. You had a foreclosure on your house 2 years ago. Oh, can't mess with you. You had a repossession on your car 2 years ago. Can't lend you no money. That's what happens. Then what do? You can't go to the big boys, so you go down to one of the regional boys or one of the community banks, and you get yourself in there. But see, the problem is you haven't learned nothing. You haven't learned anything about finances. You haven't learned anything about how to manage your money better. And that's why we get in trouble like this, because we're not managing our money properly. We're living on more than what we make. We're trying to keep up with the Joneses. And I'm not saying all of y'all, but some of us, y'all know who I'm talking to. We're living on more than what we make. We're buying stuff we shouldn't be buying, right? All stuff we shouldn't be doing. We should be getting ourselves in a position to take advantage of this great wealth transfer that's happening right now. Yesterday, we talked about that. We talked about NVIDIA. We talked about Meta. We talked about the Magnificent Seven, the opportunity, if you only had cash, how you could be building wealth right now. The opportunity where you see a company like NVIDIA increases its stock price by $100 in a week. Just think if you had a better management of money and you had some cash that you could have bought when I recommended you buy. But see, we don't have no money because we spend our money on stupid stuff. We don't have no money. We got these expensive cars. We got these expensive houses. We got all of this stuff we spend our money on that don't put no money in our pocket. And all of the things that will put money in our pocket, we don't have any money to buy them. So all I'm telling you guys is we got to get ourselves in a position where we have an opportunity to take advantage of this great opportunity we have ahead of us. We got to get ourselves in a position. Get down in that description box. Click on that Moomoo link. Open up a new Moomoo account. Put $100 in there and get yourself 10 fractional shares of the Magnificent Seven, guys. This is how we build wealth. Oh, I don't like that. I don't want no magnificent. Then you missed it. Stay where you're at. Stay where you're at. Stay right where you're at. You will get the same results you got last year. Do the same activities you did last year. You're going to get the same results you got last year, this year. The only way, guys, we get different results, we have to do different activities. We have to. I'm asking you to do a different activity. Get down in that description box and click on the Moo link. Put $100 in there so you can start building wealth, taking advantage of some of these nuggets and these financial breadcrumbs that I'm dropping every day on this YouTube channel. I'm giving you stuff every single day that you can build wealth with. Some of you decide to, some of you decide not to. And I know some of us that decide not to, we're just not in a financial position to make a move. We're straddled in credit card debt. We're straddled in car loan debt. We got student loan debt. We got all of this debt over here that does nothing but take money out of our pocket. That we got to stop because we're missing a tremendous opportunity here, guys. This is an opportunity. Over the last week alone, guys, last week alone was such a great opportunity. Two of the 7 magnificent 7 stocks. Matter of fact, it was 3 of them. Matter of fact, it was 4 of them. You had Meta, you had Nvidia, you had Microsoft, and you had Alphabet. Alphabet stock price jumped by 15%. After it came out with its earnings report, its first quarter earnings report, jumped 15%. Now, had you been invested in the Magnificent 7, you don't miss any of that. Had you been invested, had you got down to the description box, clicked on your Moomoo link, opened up your Moomoo account, put your $100 in there, got your Magnificent 7 fractional shares, started buying more and more through fractional share trading on the Moomoo app or whatever app you use, you'd have been in position. Most of us ain't in position. So if you're not in position, you can't build wealth. Whatever position you put yourself in, that's what you build. If you put yourself in a position of debt and buying liabilities, guess what? There is no wealth there. You got to put yourself in a position where you can buy assets that build wealth. You got to put yourself in that position. You got to put yourself in that position. Let's take a look. Let's take a look at what's happening in the market right now, anticipating the Fed meeting tomorrow and Wednesday, Tuesday and Wednesday of this week. It's happening, guys. Now, if you're a smart investor, you're positioning yourself. You're getting ready to take advantage of the opportunity that's going to be created on Wednesday. There's some opportunity that's going to be created on Wednesday, May 1st. What side of that opportunity you're going to be on, I don't know. But I'm telling you right now, because I don't want no mistake here, there's going to be opportunity on Wednesday when the Fed chair comes out and makes his remarks to the country after they conclude their 2-day Fed meeting. We already know they're not going to increase rates. We already know they're not going to decrease rates. We already know with almost some certainty they're going to leave rates higher for longer. But here's what the market is going to be looking for. Let me read it here. Let me let you know what the market is going to be looking for. U.S. Treasury yields declined on Monday as investors looked ahead to the Federal Reserve policy meeting and economic data scheduled for this week. What do you think investors are thinking if Treasury yields declined on Monday? What do you think they're expecting? If Treasury yields were declining, what does that mean? Money's starting to come out of treasuries. Where's that money going to go if it's going to come out of treasuries? Where's it going? Where are these investors gearing up for? What do they know? We don't know. Money's coming out of treasuries. U.S. Treasury yields declined on Monday as investors look ahead to the Federal Reserve policy meeting and economic data scheduled for this week. What other economic data is coming out this week? Maybe there's a jobs report coming out on Friday. Why is those two things so important? Because it's going to dictate what happens to the market. Just saying. The yield on the 10-year treasury was down more than 3 basis points to 4.636%. The 2-year yield was last almost 2 basis points lower at 4.985. Investors await the Federal Reserve's meeting, which is set to begin Tuesday, April 30, and conclude with an interest rate discussion and press conference about policymakers' discussions on Wednesday. While markets are widely expecting interest rates to remain unchanged, investors will be closely watching for policy guidance from the central bank. At the top of investors' minds are questions around how many rate cuts will take place this year. If there is a chance, it could be none, and when they might begin. This comes as recent data has suggested resilience from the economy amid persistent inflationary pressures. So here we go. Investors are gearing up and they're waiting. They're saying to themselves, okay, if he says rate cuts are coming, if he continues to say that, if he gives us forward guidance that, hey, all we need is some data to support inflation is going down, guys, the market will bounce. It won't be a big bounce, but it will bounce. If the Fed chair comes out and he's hawkish and says, yeah, there's a possibility there may be no rate cuts this year. If he's hawkish, if he's saying, no, we're going to stand hard, we're going to be firm, no, we're not going to reduce anything. Yeah, we're okay if we don't reduce this year. If he comes out hawkish like that, guess what the market going to do? You're going to see a sell-off. That's my opinion. If he comes out dovish, hey guys, those 3 rate cuts are still on the table. All we need is just a little bit of data showing that inflation is coming down. And yeah, we still anticipate 3 rate cuts this year. That's dovish. The market may bounce. So that's what investors are positioning right now. They're getting all their eggs, all that trillions of dollars. They're ready. They're positioning. So as in retail investors, what should we be doing? We should be doing the same thing. We should be positioning, being ready to take advantage either way. See, I get rich either way. If he comes out hawkish, I still get rich because I'm gonna buy the dip. If he comes out dovish, then I'm just gonna continue doing what I've been doing, is just buying the bounce all the way up. If it wants to keep going higher, right? The reserve money will buy the dip. The dollar cost averaging will just continue buying the bounce up. That's what I'll do. Either way, I'm gonna get rich because I got 10 years to wait. See, that's the game plan. I don't worry about, oh golly, my $5,000 of XYZ is starting to go down in value. If you're in the right investment, you know that's temporary. What you should be looking to do is buy more if you believe in the investment. If you got a long-term outlook and you believe in the investment, what a great opportunity to buy it at a discount if the Fed come out hawkish. If the Fed come out dovish, what a great opportunity to continue dollar cost averaging in and just riding this thing for 10 years. Either way, I get rich. That's all I'm saying. Either way. So for me, I like to know the information so I know how to move. See, what I'm going to do, though, is I'm going to see what NVIDIA is doing. I'm going to see what NVIDIA is doing before the Fed, before Wednesday. I'm going to see what NVIDIA is doing. I'm going to see what Tesla is doing. Those two are my favorite. Oh, and I'm also see what Meta's doing. Those 3 are my favorite Magnificent 7 companies to just make money on. So I'm going to see what those 3 are doing. I'm going to see where they're at stock price wise before Wednesday. This will be happening on Tuesday for me. I'm going to see what they're doing. And is there an opportunity either way for me to be able to make some money? Won't abandon my dollar cost averaging. This is money that I'm taking out of reserves, right? Because I know people have asked me, well, Richard, I thought you dollar cost average in. Why do you? No, I do both. That's why I kind of tell you guys, you got to get your financial house in order so you can have some cash on the sideline and reserves to take advantage of more opportunities. But if you don't right size your house and start spending your money on crap to make other people wealthy, you'll never have any reserve money. Matter of fact, you'll probably never have money just to make regular dollar cost average investments. It's just the truth, guys. I'm not here to sugarcoat it for you. I'm just here to tell you the truth according to my opinion. The good news is all of us can build wealth if we just right size our mind and we reprogram ourselves and we live on these 7 financial millionaire mindset principles that I keep telling you to live on. If you just do that, you'll be fine. And just do it for 10 years, 15 years. You'll be fine. So either way for me, I win. If they come out hawkish, I'm going to win because I'm going to buy the dip. If they come out dovish, I'm just going to keep dollar cost averaging in, so I'm in the market 365 days a year. Because see, I still firmly believe every investment that I'm investing in today will be worth more in 10 years. I don't care what the Fed do these next 2 days. I believe that. Why do you believe that? Because that's what history tells me. History tells me they'll be worth more in 10 years than they are today. So be ready. Get your mind right. Think about your position. Think about what you're going to buy if Fed Chair Powell comes out dovish. What are you going to buy if he comes out hawkish? Where does the opportunity lie? What investments out there are sensitive to this type of information and could trade down or could trade up? That's what you need to be thinking about. What type of investments am I looking at right now that'll be sensitive to this information? They'll be sensitive if the Fed chair is hawkish or if he's dovish. How do I position myself? I've already told you what my position is. I got 3 that I'm looking at. Meta, NVIDIA, Tesla. That's it for me. Those are my only 3. That has nothing to do with my dollar cost average strategy. That's still my big 3 wealth transfer blueprint with the dollar cost average. I'm talking about reserve money. If I pull reserve money out to make more money, like I've done over the last couple of weeks, what am I looking at? Those are my 3. Can I position myself to get paid? That's all I care about, right? On Friday, the core personal consumption expenditures price index, which strips out food and energy, came in at 2.8 for March on an annual basis, which was above the 2.7 Dow estimate. There you go, man. So that's what we got. We know inflation is sticky. We know it's being stubborn. We know the Federal Reserve ain't got no other choice but to keep rates higher for longer. They got no other choice. They have no other choice, guys. They got to keep rates higher for longer. And we already know there's pain being forced, financial pain being forced on Americans. How do we know that? Because your biggest of the biggest banks in America are charging off $4.5 billion in the first quarter. That's how we know. It's not hard to find that out. We know there's pain out there in this famine economy that most of us live in. Why? Because big boy banks are charging off so much in loans. See, it'd be different if the big boy banks came in and said, you know, we made some bad investments over here in some other foreign country. We thought, you know, it was a good investment. We missed it. It's $4.5 billion that we'll just have to lick our wounds and do better the next time. It'd be one thing if they said that. No. They came out and said, people just ain't paying us. American citizens have taken out loans with us and they can't pay us. That tells me that everybody ain't participating in this boom economy. I've been telling y'all that though. Y'all know that. I already told y'all 2 economies: boom economy, bust economy. So most of us are participating in this bust economy. Now, to take it one step further, you got another regional bank that's failed with more to come. So there you go, man. There is the state of your economy. You still got this resilient job market. We know you can't borrow money. We know personal savings is almost zero. But the only thing saving most of us is our job. is our wages. We already know also a lot of people are doing what? They're tapping into their 401ks. They're tapping into the pot of gold at the end of the rainbow. Why? Because they're running out of money. They're living in lifestyles that their wages can't pay for. So they're going to their 401ks, Roth IRAs, brokerage accounts. They're going to the house equity. Doing what? Keep up appearances, keep the money flowing in so they can lead this lifestyle that they can't afford. Why else would you dip into your 401k? I mean, yeah, there are some circumstances where people, maybe somebody gets hurt, they can't work, they've blown through their emergency savings, and now they thought they'd be back to work in 6 months, but they're going to be out for 12, and they just blew through the emergency savings and they got to dip into the 401k. I get it. But let's be honest, that ain't most of us. Most of us dipping into our 401ks. Most of us dipping into equity lines to tap the equity in our houses because we're living this lifestyle we can't afford. That's what most of us are doing. That's the truth. So how do you change that? Got to change your mindset. You gotta reevaluate what's important to you in this world. Is things more important to you or freedom? Simply put, you got to sit down with yourself and your family and say, hey guys, or hey Richard, what's important to you? The $700 a month car payment for the BMW, the house I can't afford because the taxes have increased pretty much, property insurance has increased pretty much, right? Is it important to me that I'm taking all these trips and I'm spending all this money and I'm buying all these clothes? I'm going out and partying and doing all this really nice short-term stuff. Is that really what I want my life to be about? Or do I really want my life to be about freedom where I control 100% of my time and I'm able to do the things that are really important in this life? Each one of us got to sit down and have that conversation on the inside. See, we got to have that conversation on the inside. See, most people can't see you on the inside. All they can see is you on the outside. The only person can see you on the inside is you. See, nobody can really see Richard Fain on the inside. They can see me on the outside. Only I can see me on the inside, and only God can see me on the inside. So I have to sit down and have a conversation, an internal conversation with myself. Richard, what's important to you? Is it the house? Is it the cars? Is it the watches? What's important to you? Or is it the freedom? If you had to pick one today, which one would you pick? Would you pick the house, the cars, the watches, the traveling, the partying, the women? Would you pick that, or would you pick this thing over here called freedom, where you get to really build something that's important, that will last, that people will remember you by? No one's going to remember the houses you lived in. No one's going to remember the cars you drove. No one's going to remember you had a Rolex watch on. No one's going to remember you took all these nice trips. No one will remember that, man. No one will remember that. But they will remember this stuff over here that you did that had nothing to do with money. That's what they're going to remember. You choose. You choose. I'm just telling you guys, it's up to you. It's up to you. You got to choose. It's nobody's fault where you're at today financially, but you. Good news is you have a choice today to change that, right? You got a choice today to change that. And I've given you some information here that describes where we are in a financial situation. And then we're gonna hit, let me see here. Let's hit one more, and then we'll button this thing up. Let's look at the S&P and some other opportunities. Let's look at some opportunities, because I know some of you will be like, hey, well, give me some opportunities. Let's look at some opportunities. Let's look at some opportunities. Here's the headline. S&P 500 rises to kick off new week as Tesla, Apple jump. Who bought Tesla last week? Who bought Tesla when it was in that 140 range? I don't know. The S&P 500 edged higher on Monday, lifted by gains in some mega cap tech stocks as traders entered a week dominated by corporate earnings and a Federal Reserve meeting. The broad index added 0.3%, while the NASDAQ composite rose 0.2%. The Dow Jones Industrial Average advanced 100 points. Why is this happening? It's simply called anticipation. It's called anticipation. That's why it's happening. People want to make money, guys. And when big boy investors want to make money, they spread anticipation throughout the market. You can always tell when you see stuff like this. You can always tell when the big boys are positioning to do something, because that anticipation, that FOMO kicks in and stuff starts going higher for no reason. All you got to do is pay attention. For no reason, stuff starts going higher. Why? Anticipation and FOMO, right? Tesla jumped more than 11% after clearing a key hurdle for full self-driving technology in China. Who did I tell y'all I was buying last week? I don't know. Maybe that'll pan out. Maybe. Apple climbed more than 3% on the heels of a bullish upgrade from investment firm Bernstein. On the other hand, Microsoft, Alphabet, Meta, and Nvidia all traded lower. Why? Opportunity. All I keep telling you guys is just those 7 stocks. If you know what you know, you can get rich on the Magnificent 7 by itself. Just saying. That's my opinion. Don't get me wrong. I'm still a 50-30-20 guy. I'm still a 50-30-20 guy. And the 20% stands for individual stocks. I'm still a 50-30-20 guy. But my goodness, guys, if you just ride these 7 horses right here, whoo, I don't know. Let's keep moving. Domino's Pizza popped more than 4% after reporting that per share earnings topped analyst expectations. Behind Domino's, Apple, McDonald's, Coca-Cola, and Amazon are all also among the major companies sharing quarterly financials this week. It is shaping up to be a strong earnings season. Who benefits from that? Who benefits from a strong earnings season? Of the more than 45% S&P 500 listed firms that have posted results so far, about 4 out of every 5 have surpassed expectations, according to FactSet. Why do I ask you guys to consider the S&P 500 all the time? That's why. That's why. See, it's a broad-based stock market index, a broad-based stock market of the top 500 companies in America. That's why over the last 90 years, you have a 7 to 10% average rate of return over 90 years. That should be the foundation for your investment portfolio. That's the foundation for my investment portfolio, is that S&P 500. That's the foundation. That's where 50% of my money goes. That's the foundation because of this. And then I just sprinkle in a little bit of Magnificent 7 just to top that thing off. Basically the cherry on top of the ice cream sundae with the Magnificent 7. See, guys, I don't have a complicated game plan. I got a really, 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 really simple game plan. Really simple. Broad-based S&P 500 ETF, 50% of my money, so it can grow at 7 to 10% over the next 10 years. 30% of my money in a tech ETF, like FTEC, information technology, so it can grow at 10 to 20% over the next 10 years. And then your big boys, the Magnificent Seven. Sprinkle in a little Magnificent Seven. Incredible, incredible, incredible. That's the plan. Very simple. Rinse and repeat every single month. Take reserves off the sideline when I need to take advantage of tremendous opportunity. Get my little money, put it back in reserve. Keep the dollar cost averaging 365 days a year for the next 10 years. Simple plan for me, man. It's not complicated. It's not complicated. Monday's action follows a positive, albeit rocky week on Wall Street, marking a reprieve from the recent market downtrend. Still, the S&P and NASDAQ are on track to end April down more than 2%, while Dow is poised to slide more than 3%. All that tells me, guys, is tremendous opportunity, tremendous opportunity, tremendous opportunity to buy these great companies at a discount and position myself so when rates do come down at some point, I'm ready for the rocket ship to take off. That's my opinion, guys. I'm not your financial advisor. I'm not trying to tell you what to do. I'm telling you my game plan. The year-to-date upgrade in the market's pricing of economic growth largely explains the resilience in equities this year alongside the climb higher in interest rates. However, during the past few weeks, the driver of rates have shifted from better growth to hawkish monetary policy, which has been more difficult for stocks to digest. That's opportunity though, guys. That's opportunity for us. We should be buying the S&P 500 like a banshee. We really should be. We should be buying that S&P 500 right now like crazy and wait for that opportunity. Every now and then, FOMO gonna kick in. Every now and then, enthusiasm will kick in and we can make some money short term. But really the goal is to make this money long term. Everybody don't know how to make money short term. So I don't concentrate on that part. I concentrate on what everyone can do, which is long term. Some of us can do long term and short term and get away with it because we know what we're doing. Everybody can't do that. But everybody can go long. Only some people can go short. See, I go short, but I also go long. But if I had to pick one, it would be long. See, you don't need to know what you're doing when you go short. You got to know what you're doing. But when you go long and you stick with the S&P 500, man, you ain't got to, man, listen here. You give me a little monkey sitting next to me right here. And I give him $100 and tell him to put it in that S&P. Monkey can put it in the S&P and be good. Just forget about it for 20 years. And by the time he come back, when he grow up, he a little monkey now. He grew up to a big monkey. Boom. He gonna have a pot of gold. Anybody can do the S&P. Not everybody can go short, but everybody should be able to go long. That's all I'm saying. If going short makes you too nervous, don't do it. Just stay long. Stay long in the S&P. That's the only investment 99% of us ever need is the S&P. That's it. If you consistently do that over the next 20 years, the next 10 years, the next 15 years with a significant amount of money, you're gonna be okay. You're gonna be okay. You're gonna be okay. So that's where we're at, man. You know, you got big boy investors, they're positioning. They may know something we don't know, right? They're positioning for a win. They're positioning something. If you see Treasury bond, the 10-year Treasury bond slide down, that means to me, money's coming out of treasuries. That means to me, money's not going into treasuries. Money is sitting somewhere waiting on something. Money is somewhere waiting on something. What is it waiting on? See, they have information, guys, you and I don't have. But how do I win anyways? I just stay in the market 365 days a year. I'm gonna win anyways. Many of you have sent me DMs. Many of you have sent me emails saying, hey, Richard, I bought NVIDIA last week when you mentioned it. Not because you told me to buy it, but I bought it because I felt like that was, you made a strong case to put it on the short list, to put it on the watch list. You made a strong case. So I bought it. And I thank you because I'm up. Some of you have emailed me about Meta. Let's see what Meta's doing today. Let's see what all the big boys that I talk about are doing today, and then we're gonna wrap this thing up. All right, let's see what these big boys are doing. Let's see what these big boys doing. Let's start off with my favorite big boy. Y'all know who that is. And I know a lot of y'all, oh, it's not pronounced NVIDIA. You pronounce it however you want to pronounce it. I'm gonna call it NVIDIA. I know what I can call it, make money. How about that? How about I call it make money? Y'all worried about how I pronounce it. I'm gonna pronounce it any way I want to pronounce it. But I'm just gonna start calling it make money. Okay? Let's look at make money. Right now today, $866 a share, still up $100 from last week, by the way. What a win, what a win, what a win. What a win. Still up by $100 from last. So if I wanted to just say, you know something, I'm out of here. There's $100 a share profit that I stick in my pocket. 866, 867, it's down $10.27 today. I'm gonna look at it again on tomorrow and make a decision. All right, make a decision. So we see what NVIDIA is doing. Still up $100 a share from last week. Let's take a look at my next favorite, which is Tesla. Oh, Tesla's crap. Guys, this is just ridiculous. Tesla's trading at $196 today. What did I tell y'all last week? Didn't I tell y'all if you buy Tesla under $150 a share, within a matter of a day or two, a week, it could go up to $250 a share? Didn't I say that? Somebody in the chat, please tell me that's what he said. Didn't I say that about Tesla? Oh, golly, they're going to zero. I said, listen, if you can get them under $150 a share, you're going to win. Any good news? I said this, guys. I'm sorry. I'm not trying to toot my own horn because I'm no expert. I'm just a guy that follows rationality, right? Maybe that's the wrong word. That's probably the wrong word. I'm just a guy that follows the money. Let me stop trying to get fancy because I'm using words that don't even make no sense. I just follow the money. And I said this. I said, listen, guys, Tesla's trading under $150 a share. I said, they only need one piece of good news. They don't need but one piece of good news, and they're going to run up to $250 a share, just like that. I said that. I said that. Hopefully, somebody out there listened and jumped on this thing. Even if you would have bought it for the 144 it was trading at, God, that was earlier this week, wasn't it, guys? No, that was late last week. That was like Wednesday, Thursday last week. It was trading at 144 a share. Now it's up to what? 196, $50 a share overnight. Okay. They ain't done yet. You just heard the news I told you about China, now where they can do the whole self-driving thing in China now. That's a game changer. They can do the whole self-driving thing in China now, which is their second biggest market behind the US. Keep telling y'all, oh, Elon Musk, he's a clown. He doesn't know what he's doing. Okay, keep on saying that. I'm going to keep on buying it. So that's number two. Right there, guys, if you just would have taken the nuggets, NVIDIA, Tesla, nuggets from last week, golden nuggets that I gave you in these live streams, the golden nuggets I gave you last week were Tesla and NVIDIA, 2 golden nuggets. Some of you took advantage of those golden nuggets. Some of you, oh, this guy don't know what he's talking about. And again, guys, I'm not an expert. I just know the swings in these big old gigantic fast moving companies, man. They can swing like that. See, I know Tesla might get pumped down, beat down, beat down, beat down, beat down. One piece of good news, it go up by $100 a share. It's already up 50. It's already about $52 a share up from the 144, 143 last week. That's in 1 week. Let's look at Meta. Remember, Meta was down in the 420 range. It tumbled a little bit, right? CEO got on after the earnings call and start talking about virtual reality and mixed reality, and nobody didn't want to hear that. So the stock price went down. But let's see what it's done. Let's see if it's recovered at all. Still a bargain. Still at 431. That's a bargain. Like I told you, you don't need but one piece of good news for Meta, and it's going through the roof. Back to $500 a share. I'm telling you. So there you go. That's what Meta's doing. Let's take a look at Alphabet. Okay, because people have asked me this, let me go ahead and explain this to you. And again, I'm no expert, guys. I just know how to read and research, right? So people are asking me, well, what is the difference between Alphabet? I believe it's Class A or Class B. No, Class A or Class C, I think. It's one of those two. One of them is what? You have the right, you get voting rights. One of them, you don't get voting rights. So somebody in the chat tell me if that's A or B or B or C, but with one of them, you get voting rights. One of them, you don't get voting rights. I think C, if you buy Alphabet Class C shares, you do not get voting rights. But if you buy the other one, you get voting rights. So that's the difference. Because I know somebody asked me that, and I was like, I don't know. I just buy. I don't know any of that. But I went to the $1 trillion research lab, pulled it right up. I said, okay, that makes sense. So let's look at Alphabet. Ooh, shoot. Okay, Alphabet down today. Class C. And again, Class C is just only difference is you don't get a vote. You get the other class, I believe it's A, you get the vote. Yeah, is it B? It's one of them. One of them. Y'all figure that out. Go to the $1 trillion research lab and figure that one out. But one of them you get the vote, one of them you don't. I don't care which one I buy, to be honest with you, as long as it go up in value. That's all I care about. I don't care about nothing else. I don't want to vote. I don't vote anyways when it comes to these shareholder meetings. I'm a little pipsqueak. I don't vote. Let's go to Amazon. Let's see let's move on with Amazon, see how it's doing today. Amazon's up today. A little bit. 179.97 is the stock price for Amazon today. A little bit up. Remember, a week ago, I told y'all 2 most valuable companies in the world I think they said by 2030. The 2 most valuable companies in the world, one of these big time analysts are saying is going to be Amazon and Alphabet. And they went through a whole case. And I think I read y'all through that. They went through a whole case why they believe those are going to be the 2 most valuable companies in the world by 2030. They made a really good case, to be honest with you. It was a really good case. So that's Amazon. Let's look at Apple, see what Apple's doing. Apple is up today, $5.35. They're up to $174.64. So they're doing okay. Nice little bump if you're in the Magnificent 7. And then let's end it with Microsoft. Microsoft is down $5.53. So much opportunity out there, guys. So much opportunity. And I'm just giving you the Mag 7. So much opportunity. Do me a favor. Get down to that description box. Click on that Moomoo link. Open up your new Moomoo account today and get yourself 10 fractional shares of these 7 companies I just shared with you. All big boy blue chip mega companies. Probably the top 7 valued companies in the United States. Top 7 valued companies. You can throw in JP Morgan Chase in there. Oh, they're not bigger than Walmart. Yeah, they are. Market cap wise, they are. They don't make more revenue than Walmart. Now, Walmart is a monster on the revenue tip, but the value of the company is more than Walmart, right? So, but Walmart makes a lot of revenue. I mean, they do, but yeah, they ain't the Magnificent Seven, or they be in the Magnificent Seven. So there you go, man. You know, tomorrow and Wednesday are important days, and then I believe the jobs report is coming out on Friday. Let me see. Next jobs report. Yeah, I think it's coming out. Next jobs report. I think it's coming out Friday. I believe so. Let's see. Yeah, it's coming out. It's coming out Friday. So be on the lookout for that, man. The next jobs report is coming out, I believe, on Friday. And that's gonna tell us what's going on with jobs. So be ready for that. I think it's on Friday, yeah. First Friday of every month. So the first Friday of May will be this Friday. So be on the lookout for the jobs report. Be on the lookout for the Fed meeting. And then I believe the following week, be on the lookout for the CPI inflation report, right? That's coming out. CPI inflation report, PPI inflation report, all of those will be coming out. So yeah, it's going to be a busy first half of May. And then be on the lookout for a big boy moneymaker will have their fiscal year first quarter earnings report, which is NVIDIA. Position yourself. I'm gonna let you know. Because if that thing come out crazy and they do good, that thing might go to $1,000 a share, guys, just like that. So I'm positioning myself for that report. And I think for me, I'm going to take a calculated risk on that one, guys. I think I am. I think what I'm going to do is before the I'm just going to be honest with you and keep it at 100. So, and again, this is not me telling you what to do. I'm just telling you what I'm going to do. Before that earnings come out, I'm going to buy me some more NVIDIA. I think, guys, this thing goes to $1,000 a share if they come out with, if they beat expectations. This FOMO and optimism and enthusiasm might drive that thing up to $1,000 a share. I might be able to make me a couple $100 per share. Now, I don't know what it will trade at prior to that. So the caveat is, the only way I'll buy it, it has to be in the 8s. If it's anything in the 8s, I'm going to buy it a day before the earnings report comes out. What's my best case scenario? It shoots past $1,000 a share and I make a bunch of money. My worst case scenario, they don't beat expectations and they fall. They don't meet expectations and they fall by $50 or $100 per share. That's the worst case for me. So in that instance, what would I do? I just hold the stock. Because I know at some point it will bounce back, right? Let's say I buy it at $8.50. I'm not saying I will, but I'm just saying I am saying I will. I will buy it. If it's in the 8s, I'm going to buy it. Let's just say I buy it at $8.50. The earnings report comes out. They kill it. I think the stock goes to $1,000 a share. I make $150 a share. Earnings report comes out, they don't kill it. They didn't hit or meet expectations. Stock price falls from $8.50 to $7.50. Do I panic? No. You lost that round, Richard. Keep the stock right here, sit on it until it rebounds. Because you know at some point in the future it will. So for me, it's a win-win. Even if I got to buy it at $8.50, I'm hoping I can buy it cheaper. I'm hoping I can buy it closer to $800 a share, $8.25, $7.99, something like that. But regardless, if it's in the eights, the day before the earnings report in May, I'm all in. I'm all in. So that's what I'm going to be doing. But that's the only one right now on the radar. Tesla, I don't know. I think the money right now has been made in Tesla. I don't know if Tesla gets to 300 unless they got a couple more catalysts that come out. I don't know. I think the money you're going to make in Tesla, you've made. If you got in that 140 something range, you made your money in Tesla. That's what I think. But of course you guys do what you got to do. But for me, there has to be something that I see, another catalyst to drive me more into Tesla right now. I think the money's been made, at least for now. Does it retreat? I think it will. So if you made your money, you may think about, what's the exit strategy, right? Keep buying it through dollar cost average, but if you've taken reserve money and bought it and you've made some money, think about your strategy. Think about what's the next catalyst that can take it higher, right? That's what you got to think about. Well, appreciate you guys. Like I said, man, what a busy week we got ahead of us, right? We got the Fed meeting. Wow. We got the jobs report. We got enthusiasm and FOMO already brewing. So be ready for whatever the Fed chair comes out on Wednesday and say. If he says something dovish, I think the market gains. If he says something hawkish, I think the market retreats. Either way, I think there's opportunity for us to build some more net worth. So be ready to go. Be ready to go. Get yourself down in the description box. Get those free Magnificent 7 fractional share stocks. Go get them. Start building your portfolio of Magnificent 7 stocks. I don't care if you put $10 a week in each one. Through fractional share trading, do it. Consider it. Get the 10 free and then take $100, $200, $300 a month and just buy fractional shares and do that for 10 years. The goal is keep increasing, right? So that's my recommendation. That's a golden nugget. You do whatever you got to do. It's your money. I'm not your financial advisor. I'm just telling you, I'd love to celebrate with you guys wins. I don't want to be on here just talking about my wins. I want to celebrate our wins. But the only way we win together is we got to execute. You don't win if you don't execute, guys. Not in this game I'm playing. I'm in this financial game that these people don't care anything about you. The 1% don't care anything about you. The game I'm in, you got to come on with it. You got to execute. Don't get outside yourself now. Don't put yourself in harm's way, but execute. I don't care if it's $100 a month, guys. Richard, I don't have that much money. Do whatever you can. Whatever you can. Just build wealth. Just get your mindset right. So when you do get your big payday, when you do get your money up, when you do get that side hustle, when you do get that raise on the job and your money up, you know not to spend that money on something stupid. You'll be buying more investments. Why? Because you're used to it. Oh, golly, man, I've been dollar cost averaging in for a whole year. Yeah, it ain't been that much money, but my mindset, I won't miss it. So now when I increase that money, the mindset has been changed. Now I increase the investment because I got a different mindset. But if I never change my mindset and I get some money, what am I going to revert back to? Whatever the old mindset was, which is make somebody else rich. No. Change the mindset. So when you do get your money up, boom, you know it's about making you rich, not someone else, right? So let's get down in that description box. Let's kill that Moo link and get that money, get that free stock. Also, get over to the website. Check out Richard Fain Millionaire Mentor website, www.richardfain.net. Get yourself over to the website. Get you some digital products to get you to your freedom, man. Remember, we got two choices. We got freedom or we got what? Things. Those are the two choices. I'm going to hang my hat on things or I'm going to hang my hat on freedom. Which one is more important to me? Driving a BMW that depreciates in value, takes money out of my pocket. Nobody will remember me when I sell that BMW. No one's going to say, well, Richard was a good old guy. Man, I love that BMW he had. Nobody going to say that. Nobody gonna say that when I leave this place. But somebody will say, you know something, man? That man had a great lifestyle. He was at peace. He ain't had no stress. He didn't worry about no money. He took care of his family. He helped people get wealthier. Wow. Yeah, that's what they're gonna remember. Ain't nobody gonna remember your big house. Ain't nobody gonna remember this overpriced car you driving. Ain't nobody gonna remember no Gucci handbags and no Michael Jordan tennis shoes. Ain't nobody gonna remember none of that. This is what they're gonna remember, the freedom part, not the things part. So get yourself in a position to get you some freedom. Get over to the website, check out them digital products. They're gonna help you get the freedom. It's an investment in you. You are your biggest investment you will ever make is in you. If you don't want to invest in you, why would anybody else invest in you? They wouldn't. You better learn how to invest in yourself, people. Get yourself over to that website, down in the description box. Learn how to invest in you. If you won't spend $19.99 to buy you an ebook to guide you through something to get your mindset right, I don't know what to say. I don't know what to tell you. I do not know what to say. Honestly, I don't even know what to say. If you don't think enough of your freedom to invest in you, I don't know what to tell you. That's why I love the membership club. See, on YouTube, it's hard to gauge, man, who's serious about this thing and who ain't serious about it. But in that membership club, you got to pay to be in it. See, when people pay their money to be in something, that typically means they're pretty serious about it. See, that's why I love the membership club, because I know the little bit of money that they do pay to become a member and the value they're going to get for that little bit of money. Come on, man. It's ridiculous. It's ridiculous. For $15.99 a month, the value you're going to get. Come on, man. It's ridiculous. But that's an investment in you. That's people who are serious about changing something and going from things to freedom. If you want to be a part of that, get over to the website, click on that membership, sign up, pay your money, sign up, ready to go. May 6th, boom, we in there. We kicking this thing off. We gonna be in them live streams I sent an email out yesterday to the membership club. Guys, tell me what day and what time you want to meet, because I want to include everybody the best I can. Now, I'm not gonna satisfy everybody, but my goal is to get out of my comfort level and say, you know something, Richard? If you want something, you got to give something. So if I got to do that call for 90 minutes every week at 8 p.m. Eastern time or 9 p.m. Eastern time, which cuts into my time where I get to do what I want to do, I'll sacrifice that for my people, because I want all of them to be able to be on that call. Because see, and on those calls, we're not going to talk about excuses. We're just going to talk about what? Solutions. No excuses, Here's the solution. We're not going to be talking about no problems, no excuses. It's just solutions. So if I got to do that meeting at 8 o'clock at night or 9 o'clock at night, so the majority of my members can be into that thing and really get the bang they're looking for, then that's what I'm going to do. So I'd never do that on YouTube. I would never be like, I would even do it in my one-on-one sessions. Y'all know if y'all have done a one-on-one session with me, it's 5 p.m. Eastern time or earlier. That's it. I don't do anything after 5 p.m., but I am for the membership club. Why? Because I'm serious about this. I look at this as my legacy. I look at this as me being able to leave this place and say, I helped these people get to freedom. What a blessing. What a blessing. So check it out. Check it out. Check it out. Make sure you hit that link down in the description box for the Instagram page too. We're trying to get this Instagram page up. So for you guys out here that are Instagrammers, give me a follow, give me an email, or not an email, but a DM, and let me know you're rocking with me. I appreciate y'all, man. Y'all have a great rest of your Monday. Prepare yourself for tomorrow and Wednesday. Two big days. Really, the big day is Wednesday, when the Fed chair comes out at 2:30 p.m. Eastern time and gives us that forward guidance. That's going to be big for us investors, right? That's going to shape the month of May for us. And then position yourself to take advantage of these magnificent seven, right? Position yourself. Position yourself. Hit that thumbs up, guys, before you get out of here. I appreciate y'all rocking with me because y'all know I rock with you. That's why I'm here every single day on YouTube, 10:30 a.m. Eastern time. And I'm sprinkling in other content in the afternoons so that I make sure I stay in front of you guys. So I make sure you got all the update and fresh content that you can take, chew on, spit out what you don't need, digest the rest, and get to your freedom. That's my commitment. So thank you so much for rocking with me because I rock with you. Thoughts become things. You can see it in your mind. You can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy, get wealthy, and I'm going to catch you guys tomorrow. Peace.